Welcome to the Why Not Real Estate Podcast, where you will learn top strategies from world-class real estate investors, both large and small. Why not? Tune in and get started today.
So if you're a newbie, I would say, hey, don't be a multifamily guy, be a Class B garden style multifamily in SEC college towns expert, because then you are the only person who is the expert on that one very specific niche. So long way of saying of niche down and make a cross section between asset class, asset caliber, location, tenant quality, and then be the best in the world at that.
Hey, what's up, all of my real estate peeps? This is Brian Lucier, host of the Why Not Real Estate Podcast, with another episode where we interview seasoned and beginning real estate investors in the multifamily and other types of real estate realms. And I want to welcome you to the show today, all of my real estate peeps. We've got someone on the show today. I've done a lot of these interviews, and I've never had anyone doing what this gentleman is doing. So stay tuned and get ready to take some notes. This is going to be interesting, and it's a niche that I can't wait to hear more about, and I've got some questions for him. So, ladies and gentlemen, with no further ado, our guest today is the managing partner of Scholastic Capital. He's the son of a school teacher, and he noticed in his childhood the rental premium of an elite school district could command. So before launching Scholastic Capital, he consulted for Fortune 500 companies and is in some of the top private equity funds as an independent consultant. Following his early career as a top-ranked consultant at Boston Consulting Group, now the proceeds from his consulting career he has used to purchase real estate and to test the Scholastic Capital thesis market plan. And I'm happy to say that he's here today because it's working well. So our guest currently lives in Chicago suburbs with his wife and two children, including a third on the way. Is the third still on the way? Don't say anything, just shake your head. Okay, perfect. All right, no spoiler given away there. So our guest also, this is pretty prestigious, has graduated with honors from the Wharton School of Business. Hallelujah, amen. And was recruited as a member of Penn's heavyweight crew team. So, ladies and gentlemen, all of my real estate peeps, it is my pleasure to introduce and have on the show today managing partner of Scholastic Capital, Mr. Sean O'Dowd. Sean, welcome to the show.
Hey, thanks so much for having me. Really excited to be here today.
Yeah, as we are as well. And I'm not going to give away what you're doing, but we're going to roll into this, and I'll let you just kind of unfold it before us here. So let's just jump in. You're in real estate now, and I've read up a little bit about your story, how you were intrigued at a young age when you saw this happening. So can you tell us, and again, it was in the bio, but we'll go into detail here. Can you tell us a little bit about your background and what you used to do before getting into real estate?
For sure. So before getting into real estate, I was a consultant. Finished up school in Philly, came out to Chicago, and worked for a big consulting firm. Did kind of a wide variety of projects, largely for Fortune 500 companies and some private equity firms of, hey, we've got XYZ problem. We want to hire a consulting firm to help us solve it. And then did that independently for a couple of years as well. All in, it was about 5 years or so where it was consulting full-time.
So college to consultant, solving problems for Fortune 500 companies.
Mm-hmm.
Okay, so what was that light switch moment that flicked in your head to think, okay, maybe there's something in real estate? And I know you have a different spin on it than anybody else we've had on the show. So why don't you tell us your story?
For sure. So on the real estate standpoint, so I actually moved 22 times before I went to college. So we moved a ton growing up. So that was...
Hold on. 22 times?
22 times. 22 times before I went to college.
What was that time span that you moved 22 times?
It was so at first move I was about 2 years old. So we were averaging a move every like 7, 8 months basically while I was growing up. So it was a ton of moving. I got really good at packing up boxes and unpacking boxes. It was just a kind of a weird skill set that I got really good at. But it was that was what the intro to real estate was hey, every like 7, 8 months we got to find a new place to live. That got me really interested in this whole fascinating concept that is real estate.
Okay, so you got to give me some of the background here. Why every 7 or 8 months? What was the situation, the circumstance behind that?
Yeah, my dad's job. He was started his career as a sales rep, and the company that he worked for, like different territories. The company he was with merged with another company at that one point, so we had to move, and then they were merged with another one, and it just basically led to the point where we just were constantly on the move while I was growing up.
So around the 11th time moving, did you figure maybe we'll just keep the stuff in the boxes just in case?
It was that was actually exactly what happened. Like there was some boxes, no matter what we always open the silverware box. Like you got to have forks and knives and all of that. But there were some boxes where we were like, you know what, like we're gonna keep this one as is just in case. And then just in case kind of always ended up happening.
Oh my goodness. So we deal with rentals, and there's a saying we say in here, if you've moved twice and not opened the box, throw it out.
Yeah.
So,
Well said.
I don't know if that applied, but and now it's rear view mirror, but wow, that's interesting. So your dad was the sales rep and your mom was the teacher?
Mom's a teacher, that's right.
So on all these relocations, she was able to land on her feet and get a new teaching gig?
Yep, and it was a wide variety of schools. Sometimes it was a public school, sometimes it was a private school, sometimes it was a Montessori school. It was sometimes she was a computer teacher, sometimes she was a librarian. So it was different. But for the most part, just in about every spot was she was able to find something at a school doing some sort of teaching.
Oh my goodness. Okay, so here we are. The truck is packed. You guys like just should have had stock in U-Haul. So you're in this situation, you're seeing every 7 or 8 months. I'm guessing you were renting homes every 7 or 8 months.
Sometimes renting, sometimes purchasing.
Okay, so unpack that for me and our guests a little bit. So you're seeing all these different situations, you're renting, you're out, you're owning.
Uh-huh.
So what was that thought process like where the light bulb went off and you thought, wait a minute, there's something here?
Yeah, so I was probably 10, 11, 12, 13, somewhere in that ballpark. And I started realizing just by all of the moves that we were doing, we lived in a really called wide spectrum of places growing up. There were some towns where most people didn't go to college, a very small percentage, or not everyone finished high school. And I lived in towns where um, I had a classmate whose parents owned an NFL football team, and it was just a kind of a wide spectrum of, and I noticed very early on with I'm partially biased because my mom's a teacher. I noticed that kind of like the one big pattern was no matter where we lived across the country and internationally, we did a couple stints internationally as well. No matter where we lived, there was a really good school district in that area. And like everybody knew that particular school district. That was a phenomenal place to be. Everybody, all the parents wanted to get their kids to go there. And I was like, oh, this is kind of an interesting universal human trait where there's always a good school district around and people know that school district and they want to get their kids into that school district. And that was the big realization.
So because of your situation, because of the several moves, dad being a sales rep, mom being a teacher, at 13 years old, my God, I think I was trying to figure out how to build model planes, and you're exposed to this market realization that the best places to live were where the best school systems were. And you were able to figure this out because you've seen this full spectrum, all the way from people finishing high school to college towns. Is that a good way of unpacking that?
That's a good way of unpacking it. I mean, call it by 14 years old, I was on my 12th town. And I was like, okay, like there's a lot of different examples here of like every different time we're moving. Sometimes we lived in the good school district, sometimes we didn't. But after you'd seen 10, 12 places in a row, where, hey, there's a really good school district around and people care about that really good school district, like there's something here. There's a pattern where this good school district is a driving factor of how people make decisions about where to live.
All right, so you set the stage. We know how you got the inspiration. What was that point from being a consultant for Fortune 500,
Mhm.
flip the switch? I mean, I hear all the time overnight success, and it only took 20 years. Your overnight success from becoming Fortune 500 consultant to becoming a real estate entrepreneur. What was that journey? How did you get from point A to point B?
Yeah. So the idea was there, like, hey, good school districts mean something. Being a consultant taught me how to do, for lack of better words, like due diligence on a market. I was doing a lot of due diligence work as a consultant. Should I don't know, we'll make a fake example, like should Pepsi buy Olipop soda, for example? Like those kinds of questions were the questions that I was working on, and I learned how to do that diligence process. So I started thinking about real estate through that lens of, okay, I know I believe in good school districts. What does a really good school district look like? Break it down from a supply and demand perspective. The good school district's the demand driver. That's why people want to be there. The good school district is why people demand to live in this town. Let's look at it from the supply side standpoint, though. If you look at, say, owner occupancy rates, for example, it's really easy to get that data from the IRS website. If the owner occupancy rate in a town is 65% national average, there's a lot of rentals available. So the demand's really high to be there, but if there's a lot of rental supply, then price is going to be what price is. But if you find a really good school district where the supply side, then owner occupancy rate is 90%, well, now you don't have a ton of rentals available. And then if you go one step further and you buy in an area where it's 90% owner occupied and there aren't any buildable lots left in town, every lot already has a house on it, it's completely full. Well, now you've got supply is capped. You've reached the max possible supply you can get to. You don't have a lot of rentals. You've got a lot of people who want to be in their town. You've got really favorable supply demand dynamics. Let's buy some houses there and see what happens.
Wow. I'm soaking that in. I mean, you could apply that whole metric to any type of real estate and figure out where you are for your supply and demand metrics. So did you find in your research that the higher school districts, the higher level of school districts fit into this model of low supply and high demand?
We did. It's not perfect. It's not one-to-one. For example, there's really good school districts that have owner occupancy rates in the 60s, 70s percentage ranges. But there are some, so there's 37 zip codes in particular that we focused on. And those 37 zip codes have really good school districts. And there's a bunch of data we use to define really good school districts and very limited rental supply. And for that reason, we can buy houses in them and charge a premium rent and be able to successfully get that rent from tenants.
So that's really interesting. I've had a lot of different investors on the show, and they label it as their buy box. That's their criteria for buying. And you have a couple levers in your buy box that my normal investors coming on the show are not looking at. So your 37 zip codes, your higher level school systems. So that's one of your big key targets.
It is.
Okay. Now, comparably, if you're buying in your buy box as opposed to generic USA America,
Mhm.
You finding your purchase prices and your rents higher?
We are. So our average purchase price right now is $480,700. So it's more expensive than the average house in America, the median house in America. It's also more expensive than what you see a traditional SFR fund, an Invitation, Tricon, Blackstone, HPA, Progress. We are buying more expensive houses than most single family operators are.
So
But
please go ahead, because that's really interesting. Keep going.
So the home price is more expensive, but we are getting higher rents. So our rents are $3,500 really to start. They go up to $4,500 a month. We exclusively do multi-year leases. We sign 3-year leases with our tenants with annual rent escalators. And the tenant mix is pretty different. I mean, our two most common jobs that our tenants hold is doctor and software engineer. And our average tenant makes around $205,000 a year. If we stick with like the Invitation comparison, for example, Invitation homes, they do report this metric publicly. Their average tenant makes about 110 to 117,000 a year. So they are much bigger, they're much broader than we are. We've got a pretty small kind of specific niche. We're never going to be nearly as big as they will, but for our little spot, like we're going to buy more expensive homes, but we're going to put more expensive rent in there with really high quality tenants.
So circumference to colleges. I mean, when we're talking about better schools, are you all the way from like K-9 up to college? In your buy box,
Mhm.
they're like different levels. Like, here's what we're looking for in a pre-K, because the kids will grow up and have to move, as opposed to like graduate students, international students, stuff like that.
Mhm.
So in your different tiers, how does your buy box change in those different tier levels?
Yes, so we're exclusively looking for so we're not looking on the college basis. We're exclusively looking for kindergarten through 12th grade school districts, and most critically high school. We find the vast majority of our tenants move into the home when their eldest child is 14 and about to start high school. And in most cases, it's tenants basically looking to upgrade school districts for their kids to go to a great high school because they want them to go to a great college. So that's pretty bread and butter for us is really high-end high school districts, and that's also why our tenants are signing multi-year leases, because they're moving in when their child's a freshman. They have no intention of leaving until their kid has a diploma, so they might as well sign a multi-year lease because I know I'm going to be here until the kids are graduated.
With escalator clauses, are you looking at like 5%, or is there a set percentage in your leases?
It ranges from 3 to 6%. We negotiate that first. That's the first thing where if a tenant is pushing back on pricing or anything like that, like taking down the escalator is the first thing we negotiate.
So it snows in Chicago.
It does.
It does. Now, in my world, multifamily, if there are common driveways, common egresses, it's the responsibility of the landlord. You're able to shift a lot of the home maintenance, mowing the lawn, all that stuff onto the tenant.
Correct.
Huh. So describe to me, okay, so we've looked at the market part of it. We've narrowed it down to the K-9 through 12,
Mhm.
or 3-4 year leases. So
Mhm.
you're filling in a really interesting picture for me here.
Mhm.
Describe to me, what type of house is that family looking for? Is it like 2, 3, 4 bedrooms, 2 baths, garage? What, I mean, are these McMansions? I mean, what type of properties are you buying?
For sure. So I can give you what our average property looks like right now, and then like what we look for. Average property right now is 3.2 bedrooms, 2.1 baths, 1,760 square feet is our average house right now. And in terms of like what we're looking for, 3 beds, 2 baths, we want to be within 1,400 to 2,100 square feet. We want everything to be relatively new. Inspections, there's a whole list of specific criteria based off mechanicals. But there's also a bunch of, for lack of better words, buy box elements. Like we are building this portfolio to sell it. So we need to make sure that we're building the portfolio in a way that a larger institution is going to want to buy it. So we have to follow their buy boxes too. So easy example, like no double yellow lines. We have to buy homes on streets that are 25-mile-an-hour speed limit or less. If it's faster than that, we can't sell it to an institution, and it's also going to be harder to rent. We got to have a garage. No solar panels, non-starter. We could try to sell the house for $1 to an institution. If it's got solar panels on it, they don't want it. No pools. There's a bunch of kind of specific criteria that we have to follow to, well, number one, get yield for our investors now, but be able to sell it down the line, which actually makes our job a lot easier because we can sift through a lot of listings very quickly to find the actual homes that we really want to buy.
That is very, very smart. And to be that detailed, you can get to know faster, which helps you to just, okay, no. Or I'm an older guy. I don't know if it's left swipe or right swipe. Whichever one is the good one. Is that a right swipe? You're married. Don't answer that question.
Yeah, it's a good question. I don't know.
Okay, but you know where I'm going. Like,
I know where you're going with it. Yeah.
Things that, no, yes, no. Okay, so being that specific and granular, that's really interesting. And I got to jump back because you made me laugh here. Your price per home, and you're going to correct me because you know the answer, was $480,730.
761 is the exact purchase price right now.
I'm laughing because it doesn't say 99 cents. Because to be that specific down to $1, right? That is, man, that just shows so much thought going into this. And for anybody listening to this, I mean, it's a negotiation technique on the other side of it. Like if I'm making an offer on a house or something like that, I'm not going to say, oh, I'll pay $500,000. It would be $498,642.23. Because then the perception on the other end is, okay, this guy has run and crunched some serious numbers to get there. And when you came down to $761, it's like, okay, this guy is near rocket science. And we have had rocket scientists on the show. So, all right. So that's really cool. I want to kind of frame myself, get back. So this is super interesting. I get a pretty good picture. And thank you for being so transparent. I mean, your buy box must be like 2 or 3 pages long.
It's very lengthy. It's very lengthy, and it takes a little while to go through for each individual house, just because there's so many different things that we're looking for.
Okay, so I love operations. Is this something you could give to a virtual assistant and have them pull the levers, or does this have to be hands-on for you? I'm wondering how scalable the model is.
Gotcha. So we do have a team. So we built out a team. We've got 3 people full-time. And we've done a bunch of benchmarking for, so where we think we're going is goal and expectation is we want to be at $250 million worth of equity in the fund by 2030. And we've done a lot of work looking at funds that are also by single family, that also use third-party property management. And most of them are in the neighborhood of 7 to 12 full-time employees. So we think our team, call it, it's going to be about 10 over the next, call it 4 to 5 years.
And at 230, what's your benchmark you're looking for? $1 million value?
So our average home is about, so we're trying to get to 250 million total.
That's the number, 250 million. Okay. And for that 250 million, how many properties do you estimate that is?
To be about 500.
500 properties.
And that's really the sweet spot. Because if we sell the homes as a portfolio, a portfolio of 500 homes is more valuable than a portfolio of 200 homes. It's easier for someone else to fold into their portfolio size themselves. But if we get much bigger than 500, especially at our value per home just being a little bit higher, the number of potential acquirers for our portfolio goes down.
Ah,
And 500 is kind of the sweet spot where there's about a dozen shops or so that could buy us at that size. But we also get a lot of value from the portfolio being 500 homes. If we were to go to say 750 homes, then call it 12 acquirers goes down to like 4. And then it will hurt our investors on the sale as a result of that.
ooh, interesting. All right. So we're gonna drill down on a few of these deals, but I'm gonna rabbit hole around here a little bit. So how many years has Scholastic Capital been in operation?
It depends on where you count the start. So I've been buying these homes myself for almost 5 years at this point. I was testing the thesis with my own money, the consulting income for a couple of years before launching. We launched Scholastic about 2 years ago, and then we started buying homes through Scholastic about 7 months ago. So it's either 5 years, 2 years, or 7 months, depending on where you want to count it.
Okay, so if I were to backtrack all the way when the idea was planted, the seed, that would have been
Yeah,
13.
or like 15 plus years ago, or
Okay.
almost 20 at this point. Yeah.
So let's benchmark it this way. How many years ago was your first closing on this type of property?
Uh, four and a half, four and change. So almost 5 years.
Let's call it 5 years.
Mhm.
Right. So 5 years of experience. And what's the value of the portfolio roughly today?
Right now we're at 11 million. When we're buying about 3 or 4 homes a month, it's another 1.5 to 2 million per month that it's getting added in.
Huh. So the the speed of your growth is phenomenal. But
Thank you.
to credit you, it's because your focus is laser. If you had a broader range of, well, maybe it's this or maybe it's that, that would actually slow you down. But because you can no, 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 yes, no, 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 yes, no, yes, and get there quicker, you're able to move quicker. And I imagine when you sit with an investor, within 5 minutes, they're in love with you because they just know like you're a computer. Where I mean, you kind of have to be. I mean, for you to sit down and I'm going to keep just coming back to $761 because, that shows a level of detail and, you're not fudging anything. You're going in and you're running it. So your investors coming in. So here you are now. About what do you got? Like a half dozen, maybe 10, 12 investors who are in with you now, or is it broader than that?
It's broader than that. Uh, again, I guess also kind of depends on how you count it. In terms of individuals who got money in the fund, we're about 40. And then we've got another 5 or 6 who have signed subscription docs and are going to be sending their capital most likely next March. We're the way that we're set up, just with our tenants being families with kids in school, the vast majority of the tenants move between school years. So we want to have most of the capital show up March, April, so we can basically buy spring, summer.
Interesting, interesting. So, man, your operations seem watertight. Now, this is all to lead into my segue question here, because this is a fun one for me. And you're in a specific niche, so I really don't know where this question's going to end up. But I'm going to roll the dice and let's see where we go. So you're 5 years in from your first purchase, and I'm sure there was a couple of years of research before that. So this question has 2 prongs to it. The first part of the question is if you could go back to your beginning 5, 6, 7 years ago when you had that I'm going to do this moment, advice would you give to yourself if you could go back to that moment? And then the other side of the coin is what advice would you give to a newbie starting out today who thought this might be something they could do? So let's start with you. What advice would you give to yourself if you could go back in time and tap yourself on the shoulder?
The advice I'd give to myself back in the day would be very mindful and careful of leverage. I I'm increasingly of the belief that there's something called like this. This is what I call it. I don't know if it's the right way to describe it, but there's something from a mashup of like matching the conservatism from the debt and the equity strategy. What I mean by that is like I'm buying single family homes in really good school districts. Like it is very conservative on the equity side. Like we're not trying to reposition a multifamily here. Like on like a 1 to 10 risk scale from my perspective on the equity, I'm at like a 2 out of 10. I think the way that I think about it now is like the debt and the leverage that I use should also be like a 2 out of 10 on the risk scale as a result of that. So for example, if I take a very boring, stable, basic asset like our homes, and we're to put on like 5-year term floating rate debt with no rate cap, like that's extremely risky debt. It doesn't make sense to use super risky debt for a very vanilla risk strategy. I think it makes more sense to match debt and equity up. And that's kind of been a thinking that I've evolved to over the past couple of years. And like, it would have probably saved me some time if I had that advice, call it 5 years ago.
Okay, so here you are. We'll fast forward to where you are today. And I'm sure you know this number down to 761, but is there a ratio that you like to see? I mean, what's your typical? Are you doing like 30-year mortgages? Are you doing 20, 30% down? What's conservatively, what's your, okay, I'll do this deal. What's that number?
So we're right now we're at 59.1% LTV on the portfolio, 30-year fixed debt exclusively, no float, no refinance, no term. I think there's an argument that itself is potentially too aggressive for the strategy that we're doing. I think we probably will decrease LTV over the next 12 months or so on the portfolio.
It's interesting that you think that is aggressive, because I was at a RIA last night and these guys did a $30 million raise for an $85 million apartment complex. And, that's way more risky numbers than your 59.1%.
Agreed. But I also think that's a more risky equity move. Like I think like matching up the 2 out of 10 numbers, like they're probably like 4 or 5 out of 10 on a risk perspective. So like 4 or 5 out of 10 risk debt, like feels right to me. But if we're at like 2 out of 10 equity risk, then like 2 out of 10 equity risk debt or 2 out of 10 debt risk feels right.
So this is very interesting because in your model, I can't think of Sejong or The Art of War. Okay. So you as a warrior are more nimble than a 340 complex that all needs to be sold together. If a life event happens to you, you could take, I don't want to call it a dog, but in your portfolio, you're going to have diamonds and dogs.
Yep.
Somewhere is going to be the top and somewhere is going to be the bottom of that portfolio. You could get your dog, recover, very nimble and quick, and maneuver faster than that other type of portfolio, a larger complex.
That's exactly right. Like I think we got more flexibility, and I mean, law of big numbers. Like we've got 500 homes in the portfolio. Like if you own 500 homes for a decade, that's 5,000 home years of ownership. Like you're going to have one of those homes is going to burn down. Like it's statistically expected value over greater than 1. It's like likely to happen. Like if that does happen, then okay, we can sell the land. We can make those decisions because we've got the flexibility to do so in that case.
or a contractor special, right?
or a contractor special.
So contractor special, that I still have to get to the newbie part of it.
Hmm.
When you're buying, I mean, I deal with a lot of apartment owners who are looking for value add. They won't buy anything unless there's value add. It
Mhm.
sounds, and correct me, that you're looking more for a turnkey that everything's done and you don't have to go in and renovate.
That's correct. We very much don't want to do value add work. The big reason why is because we've got that window. We want to try to get the homes leased in the summer. So if we take on construction risk and then the project doesn't finish until Christmas, then it's hard to rent the home. Um, the other element too is we collect so much data on the homes when we buy them. Like I've got make, model, serial number for every single thing in every house. So when we go out from the inspection, it's not like, oh, the inspector like said this, and this. It's like, okay, the inspector said all those things. Our contractor's reviewing what the inspector said. And oh, by the way, we have all of this data on the assets. I can say the expected useful life of the fridge is going to be another 7.1 years. The expected useful life of the furnace is going to be another 4.6 years, whatever. But I can use that to then adjust my maintenance forecast of it's no longer, I'm just assuming some flat percentage. It's I can be thoughtful about this. Like the fridge I'm going to need to replace in 7.1 years. The fridge costs $1,000. I should be putting away $120 per house for this house per year to pay for that new fridge down the line.
Sure. We call those sinking funds. Like a roof is 15 years, you divide the cost of the roof by 15. That's what you save. In the 15th year, you write a check because you don't have to go out of pocket. So
Exactly.
it's so super smart of you to have every serial number, every code 7.1 years before the refrigerator goes out. Because when that institutional buyer does come in, they're not going to have any questions.
You nailed it. That's exactly right. Because this is going to sound ridiculous, but the way that I think about it, because like I used to be that analyst doing this work. There is someone out there right now. They're probably in elementary school right now, but 10 years from now, they're going to be an analyst at Blackstone, and they're going to be looking through my data to say whether or not we want to buy Scholastic Capital. And my job is to make that kid's life as easy as possible a decade from now, where he's going to be like, this is nice, tidy package. All my information I could ever need is right here. It is very easy to make an underwriting decision about whether or not to buy Scholastic because all the data is right there.
It makes your life easier too, because you're documenting this city of 500 homes as you go.
So exactly.
It's not going to be like, okay, we're going to close this deal in 6 months and run around with your hair on fire, answer all these questions. You're just going to like drop 5 pounds of data or click and hit send. And there it is. It's that teenager who's in high school right now trying to figure all that out.
Exactly. That's exactly right. And it makes us better operators too. Like a huge driver of tenant happiness is how quickly you make repairs to a house. Like if the tenant calls us and says, hey, the furnace is out and it's cold, great. We call the HVAC guy and say, hey, you're going to 123 Main Street. And oh, by the way, the furnace is a Lennox 1234 installed this year. Here's the last 3 service events. We think it's probably this based off of its history. Make sure you bring the parts. And then the HVAC tech goes, okay, great. So like my life is easy now. I don't need to like drive there then drive back to the shop. Like I'll bring the right stuff with me. I'll get it done and I'll be home at 4. And our tenant's happy because it's one trip and then everything's solved.
Wow. We're at 300 doors and I'm going to drive my guys crazy. Well, just over 300 doors. I say, okay, if you got downtime, I want you to get serial numbers on everything. But doesn't it save us money down the road? I mean, it might be a couple hours of maintenance that we have to charge our client now, but we're going to save them hours and hours of maintenance, those drive back and forth trips.
Exactly.
I learned something on every show. So let's jump back to that teenager in high school right now who 10
Mhm,
years from now is going to close your deal.
mhm,
And we'll segue back to the other side of that question. So, what advice would you give to a newbie today who is
mhm.
thinking about doing what you're doing?
I I think that my biggest piece of advice would be to get very focused on an asset class, caliber of asset class, and location, and maybe even tenant cross section. What I mean by that is uh call it 5, 10, 15 years ago, like I feel like you could be like, okay, like I'm a Sun Belt multifamily guy, for example, and not super competitive. There's not a lot of people who are doing that. It's a lot more competitive these days. And if you're like a Sun Belt multifamily guy, for example, like there's a lot of there's a lot of competition. And getting more niche and getting more specific makes sense. So if you go from, or for example, like single family, like we do single family, we went, I'm not looking at all single family, I'm looking at single family homes and very high-end school districts for a $200,000 a year tenant. Like that's very, very specific. I think this is not like not tuning our own horn, but like I think it's fair to say like we are the best investment fund in the world at single family homes in high-end school districts with a high-end $200,000 a year tenant because we're the only ones doing it. So if you're a newbie, I would say, hey, like don't be a multifamily guy, be a class B garden style multifamily in SEC college towns expert, because then you are the only person who is the expert on that one very specific niche. So long way of saying of like niche down and like make a cross section between asset class, asset caliber, location, tenant quality, and then be the best in the world at that.
I think you just gave like the secret sauce for any real estate investor. Because if you're going to be so specific and focused on your
Mhm.
market, on your buy box, and you answer all of these questions, just like you said, you have no competition because you're the only one looking at it through that lens.
Mhm. Exactly. Like I get asked all the time, like, hey, you're buying in expensive areas. Like, how are you able to find homes that cash flow? Well, it's because we're the only ones who are looking in these zip codes. Like, and we've seen so many deals, we can identify the ones that cash flow and the ones that don't because it's all we do. So it makes it easy. Like, uh, across all of our zip codes, about 6,000 homes a year get sold. Like, we look at all 6,000 of them, but we're the only ones who are doing that. So it makes it easy for us to be able to say, out of the 6,000, here's the 240 that we liked.
So you have a lot of diamonds and not many dogs.
That's the goal. And that's right.
I say this all the time, and I think you will appreciate this.
Mhm.
How do you get a parking space up front?
Hmm. What do you mean by that?
You're going to go to CVS or the
Mhm.
Walgreens. How do you get a parking space up front?
Get there early?
You look up front. You look there.
I like
So
it.
you're giving out your secret McDonald's sauce recipe here. The asset caliber, the asset class, the asset location, and the type of tenant, which is
Mhm.
interesting because this complex I went to last night,
Mhm.
their tenant base are doctors, dentists, international students,
Mhm.
and that just happens to be the people who are coming into this complex. And this is like an
Mhm.
plus brand new complex.
Nice.
Well, now this was in retrospect for them because they didn't have the target up front. This is
Mhm.
after they signed leases who came in.
Mhm.
So that's interesting. All right, let's keep going here. I'm having a good time. I hope you're having fun too.
I am.
So I got a pretty good vision of what your properties and what you're doing looks like. So now we're
Mhm.
going to go granular on a deal.
Okay.
This one is, what's the best deal you ever did? What type of property was it? We know that it's a single family home in an
Mhm.
Austin school district. How
Mhm.
did you find it and how did you finance it?
Okay, cool. There's a bunch of different ones we can do. 'Cause they're all very similar on this because it's all the buy box. Um, okay, let's do. All right, I got one. Let's do it. What was the first question?
What's the best deal you ever did? What type of property? We know it's a single family.
Mhm.
So how did you find it and how did you finance it?
Yes. So on the finding it, so we are MLS focused. So we have built custom software. It sounds more impressive than it actually is. We used like a lot of pre-made stuff, but we have custom software built in where basically every 5 minutes, every new home on the MLS gets dumped into our software. And because we've got very specific filters of what we're looking for, it automatically dumps out and like spits out 90% of them, just go like, nope, not interested in them at all. Then the ones that are left, we do our like manual overlay of like, is this house something that we'd be interested in buying? There's like 17 different things we score. If it passes that, then we get to what we call financial underwriting, is like, does this thing yield what we want it to? And then if yes, we go to an offer. So for finding it, it was MLS, but it was MLS running through kind of our process on the side. Typically takes us less than an hour between the time that the home hits the market to when we're thumbs up, offer, or no offer. So yeah, this one and all of them, we're through that process.
Oh, you're a clever young man, aren't you?
Kind of you to say.
That's wow. Okay, so we know how you found it. You
Mhm,
created, even if it was off the shelf software, you've utilized this to do your swipe left, swipe right for you.
mhm.
Then if it gets through that next stage, like at any point in these stages, if it doesn't pass muster, boom, you're gonna just move it off the list.
Exactly. It just gets kicked right out.
So you get to the financial underwriting and the
Mhm,
deal makes sense.
mhm.
Okay. So now we're at how do you finance it? How do you pull down the beast?
Yes. So the way that we think about it is because we buy a lot, we have lenders who are, for lack of better words, like we don't need to get pre-approvals per house or anything like that. They know the kind of homes that we buy, and we buy a lot with our lenders. So we just have like a blanket pre-approval from them of like whatever Scholastic offers on, like we're it's pre-approved. So we send out the offer. The goal is to get the home under contract immediately to lock up exclusivity on the house so we can do the inspection. And then once we're under contract, we shoot the contract to our lender, and it's like this is what we bought today, or we went under contract on. Um, let's get started. 65% LTV typically, 30-year fixed debt, and interest rates are variable depending on what's happening at that particular time.
Yeah.
Um, and then yeah, they get kick started on the appraisal from there.
Okay, so now we're going to drill down to the financing because this is really
Mhm.
interesting. And this will make or break the deal.
Yes.
You have what, three, four, five, half dozen different lenders in your corral?
We have three primary ones. One is the main, and then there's two challengers.
Challengers. What an interesting way to describe them. All right. So primary one hits the deal. And actually, I have a question behind the question.
Mhm,
I know in my world, Joe and Nancy Normal buying these types of homes can hit 10 deeds before they trip Fannie and
mhm,
Freddie to get into commercial.
mhm.
So I'm going to make the assumption here that these are all commercial lenders.
That's correct. Some of them also do residential loans, but we are exclusively getting commercial loans on the properties. They just look and act like residential loans.
Yeah, yeah, sure, all day long.
Mhm,
Now, the commercial loans, unlike a residential loan, terms are negotiable.
correct.
So whereas you're bringing in volume, you have a hand over another
Correct.
hand that you can say, hey, I'm only going to bring you 5 mortgages this month, or this month I'm bringing you 6 mortgages. Can you give me a point or something?
Exactly.
Is
Exactly.
that, has that ever happened?
It does. So we weighted average interest rate right now in the portfolio is 6.15. And over this past summer, average rates were 7 to 7.25. So we're typically about a point lower than what Joe and Nancy normal are getting when they go buy something.
Because you're a return customer.
Correct.
Yeah, there's something to be said for that as well. All right. So you're going to pull this down. You got the pre-approval, everything's locked and loaded. They
Mhm.
accept your offer. What does the conversation with your investors look like?
So on our investor standpoint, we're a true committed fund. So the investors are basically writing us blank checks. That then we have discretion that we can go buy property with. Now there's pretty firm rules on what we can and can't buy. Like I can buy single family homes, I can't buy condos. I can buy homes that are 480 grand. I can't buy anything over, I think 650. I can't buy outside of the zip codes, but like within the confines of the thesis, we basically have a blank check to go out and buy.
And because you're so specific on what that is, the investor can say, okay, well, you've got your track record, you've done this, 5 minutes talking to you, and you're hitting those like point percentage numbers. And I don't think I've seen you look off to the side to refer any. So, I mean, that's impressive. So, yeah, okay, you're walking the walk, you're talking the talk, and okay, they write you a blank check. They know you're going to buy a specific type of thing. So the fund is funded. You get the approval from the bank, you purchase and sale signed. All you need to do is that point is take enough from the fund for your down payment and lock up the deal.
Exactly right.
Pretty easy, isn't it?
It's there's a lot of steps in the process, but none of the steps are that difficult at that point because it's to your point. We've got the money in the bank, we've got the house under contract, we got to do inspection, we got to have title, we got to have attorney, we got to have all of those things running. But none of it is that complex. It's just getting the checklist done, for lack of a better way to describe it.
Yeah, it takes details, it takes discipline and diligence, and that you should be doing. I don't care if you're buying a commercial gas station, a 300 unit apartment building, a single family home, or a food truck. I don't care. Now, that same diligence has to go through, and that checklist is probably pretty darn similar on all of those.
Mhm.
All right, that's cool. So we're going to keep rolling here. What's the biggest hurdle you've had to overcome as an investor, and how did you solve it?
Biggest hurdle. We've had a bunch of we'll call it like long tail situations. Um, for example, it was a rather long story, but the headline was there was a car crash in one of the towns that we're investing in, right in front of our property. And the car got like pushed into the yard and like destroyed the backyard, took down the fence, and did like a whole host of stuff. Um, the tenant was supposed to be moving in like 2 days later. Just kind of like one of those like, what are the odds that there's a car crash in front of the property, like, and destroys a lot of stuff like 2 days before a tenant moves in. That's been, we'll call it the most like long tail unexpected thing that happens. But at the same time, it's also like if you're going to own enough properties over enough years, like you're going to have like one in a million things happen, because that's just the nature of the game. And I think if we go back to like that the newbie point, like I think that's one of the reasons like why reserves are so important. Because if you own, to your point earlier, like 300 doors and you're kind of up and running, like these things happen, you're like, okay, like I can handle that, that's okay. But if you buy your first property and your 1,000,000 to 1 car crash happens on your one property and you don't have reserves, like then you're in trouble. And like this, it's the tough thing about real estate is like these things happen.
Yeah, and it doesn't sound as if it hit the house, didn't cause any structural damage. I mean, the family could still move in, so the
Uh-huh.
fence in the yard is ripped up a little bit. So what do? You give them a couple gift certificates to a local restaurant, maybe tickets to the movies or ice capades or,
Yeah.
something to compensate for their grievance, right? And then you're the hero because not only did you go beyond, a couple $100 out of your pocket to make them feel comfortable and appreciated,
Mhm.
but you've also got the insurance claim, or actually whoever caused the accident is going to pay for the damages. Okay, so
Mhm.
not the worst possible case
Not
situation.
not the worst in the world, yeah.
Okay, so typically when I shoot these from my office in Aruba, I'm buried with books behind me. I see a few books on your shelf. I love to read.
Mhm.
I'm actually reading right now Thinking Fast and Slow by Daniel Kahneman.
Mm, mhm.
I'm really enjoying that book. I'm into like the second half of the book now where he talks about the thoughts that go into investing. So I'm really appreciating that. And I'm really appreciating that Bitcoin went up to 95. But anyways, so here we are. Is there a book in your investing career that's made a big impact on you?
Yes, there's been a couple. I think the one that resonates the most with me, and I give it to investors for a gift, is "But What If We're Wrong?" It's by a guy named Chuck Kosterman. It's about 20 years old at this point, but it's a phenomenal book that absolutely kind of forces you to change your reference points about how you think about things, which it's I think a really helpful mentality to have when investing.
Is that a mindset book or is it an investing book?
It's um it's almost neither. It's more of like a thought piece. Like for example, it talks about in the book, um, it's like if you go back to like ancient Greece and Athens and all of that, um, everybody there was convinced that I think it was, I could be getting it wrong, but like the basic premise is like you go back to one of those time periods a couple hundred years ago, 1,000 years ago, whatever. Everyone was convinced that the earth was the center of the universe. And if you said otherwise, you were like absolutely laughably wrong. And it lists like dozens and dozens and dozens of examples where everybody alive was steadfast believed in something. And then like 30, 50, 100 years later was like, no, that was laughably wrong. So the concept of the book is like, um, there's things that all of us believe here today to be true that 100 years from now will be proven to be absolutely laughably wrong. And somebody in like 21, 24 will be like, oh yeah, those guys were silly for believing that. And it like forces you to, the way that it's delivered is it forces you to think about like what are your what beliefs do you have about investing that are you believe to be true that actually might not be. And like if you are wrong, how do you think about that and what do you just a long way of saying it's like it's a devil's advocate book. It forces you to play devil's advocate to all the things you believe about investing and then um makes you think like, am I right or should I be thinking about this differently?
That's so interesting because, there are parallels with the book I'm reading right now. And who's
Mm.
that by? But what if we're wrong?
But what if we're wrong? And Chuck Kosterman,
I'll find it.
yeah. It's a quick read, but it's kind of one of those books where you like read it in an afternoon. You're like, I'm going to be thinking about this for like a week or two.
Yeah, thinking fast and slow is having that effect on me.
Mm,
So there's the question that you'll ask someone, and if it's too difficult, they'll revert to a question that's similar and give you the answer to the easier question and,
interesting.
and not answer the difficult question.
Huh. Interesting.
And now that I know this is out there, I see it happening. It's like there's blue
Oh.
checks everywhere.
Hmm.
Right. So one of my maintenance guys the other day, I was asking him, okay, what's going on with the security deposit and the make ready? And it was
Mhm.
too much for him to comprehend. So he shifted to a piece of the project that we had to do mini blinds. It's like, well, no, okay, I see what you did, but I need the full spectrum answer.
Interesting.
Yeah, and it's out there. So we see it now. Is there a second book that had an impact on you as an investor?
Yes. I had to look up the title. It's called Hero of the Empire. It's by Candace Millard, and it's about Winston Churchill when he was in his 20s. There's a million books written about Churchill when he was prime minister during World War II. But what is really interesting about this book is Churchill at like 18 years old was 100% convinced he was going to be prime minister. And it's about the deliberate decision making and actions he was taking at 18, 19, 20 years old, knowing that it was probably a 40-year journey he was about to be going on. But he's like, I'm going to be prime minister, and like, this is how I'm going to get there. And I don't think I've ever read a book by somebody about somebody that's got such a like long-term mentality and like, here's how I'm going to be, I'm thinking about taking steps to get to my end goal. It's always about like, oh, I already reached my goal and like, here's how I did it, rather than the like on the journey way to doing it. It's a really, really good book.
And that is Shore of the Empire?
Hero of the Empire.
Hero of the Empire. Wow, good one. Is there a third book you'd like to throw into the ring?
Third book, two other ones that are very, very similar. There's a book called Alexander the Great, and then there's a book called Genghis Khan, Making of the Modern World. Both books have been consistently recommended to me by some of the like wealthiest, most successful people I've ever met. Always go back to those books. It's their history, but there's a big like leadership element component to both of them that is really fascinating about how both of these guys basically took over the entire world at the time of their life, and the specific decisions that they were making in a way that allowed them to, for lack of better words, like lead the world at the time.
So you apply those books to your 37 zip codes.
I don't know about that, but there is definitely an element of like what were they doing right, and like at its core it was like taking care of their people was like at its core what they were doing, and it's that has certainly been a strong lesson in terms of like our small team of three right now, like what can I do to make sure that I'm like taking care of my team, and the team is in a position to succeed with what they're doing.
That is noble. And as a leader, you need to think that way. Absolutely. That's gold. If you're listening to this and you didn't hear what he just said, hit rewind. That is gold. Now, Alexander the Great and the Genghis Khan book, do you know who the authors were on those?
Alexander the Great is Philip Freeman, and I don't see the Genghis Khan book right now. I'll Google it real fast.
Okay. While you're Googling that.
Here we go. Jack Weatherford is the author.
Perfect. All right, moving right along. What's next for you? And I kind of know you've already told some of the story, but what's next for you, and why not get started today?
Great question. What's next for me is continue to build the portfolio, buy homes, and keep moving. Why not start today? It's a great question. I mean, there's no reason not to. So I got some investors to call after this. We've got some calls with. We have to have two different accounting firms and a law firm because we're a fund. So I've got calls with one of the accountants later today, just kind of consistently trying to move the ball forward just a little bit each day, knowing that we've got quite a lot of time to go.
We're almost done. So the last question, well, there's one I have to ask how we can get in touch with you, but the question that's not on the list, and love this question because I get some of the most dynamic answers. What's the question on today's show I should have asked you that I didn't?
It's a great question.
I'll let that one sink in a little bit.
Yeah, it's a great question. I think the question the and it's the one that I think about. So it's the one that's coming to mind is how does this fail? How does this go to zero? Like what if this gets totally wiped out? Like what was the path to get there, and how? Because I think about that question a lot because I I need to, for lack of a better word, be defending against that. It's like if these are like the three most likely reasons this thing completely fails, like I need to have a defense against each one of them. It's like, okay, those three theoretically shouldn't be my biggest issues anymore. Like, what is now the new list of three things that's the biggest reasons this is going to fail? Like now I got to defend against those. So I think that's the question that comes to mind as like because at least that's what I think about most of the time.
That is a great question. Yeah, I'm not going to ask that question to you, but from a couple of decades of doing this now, it's having multiple exit strategies. That's it. So if this is keeping you up at night, just come up with a couple of exit strategies that you could quickly execute. Like we already talked earlier about a half hour ago about ditching a dog instead of a diamond if something happened, right? And I'm sure there's so multiple ways if you needed to chunk out these homes. I mean, they're desirable. There's nothing wrong. You could package up small enough packages where if you needed to pitch the tents and go nomad, you could do that relatively quickly because you have a great asset all the way down to the serial numbers on the micro.
Yep.
This has been awesome. I've never had someone functioning at an intellectual and mathematical level to understand what they were doing as spot on and laser as you are.
Well,
so
I appreciate that. It's kind of you to say.
Yeah, I'm thrilled to have you on. And of course, we'll get you all these videos. You can use these for your marketing, send them to investors, whatever. I'm sure you can do on your social media little clips here that are just going to be like small little brush fires to get people interested. Which brings me to the last question of the interview. If our viewers and people watching the show want to find you and reach out to you, how should they get in touch with you?
Yeah. So call it the like formal way is like we've got our website, scholasticcapital.com. Probably the not as formal but best way is Twitter. I use Twitter quite a bit. And I tend to kind of just tweet stream of consciousness thoughts as I'm going throughout the day and what we're seeing and the properties, what we're seeing at the fund, what we're hearing and learning from other folks. I'm typically most responsive there, and hopefully the stuff that I'm sharing out is interesting.
Excellent. Well, I'll make sure that I have all that posted into the show notes. Do you want your email out there as well?
Sure. I mean, I'm Sean at scholasticcapital.com. People can reach out whenever they want.
All right. Any last questions for me before I let you get on your other business?
Anything I should be asking that I haven't?
Touche. Well played. Well played. Well, there it is, ladies and gentlemen. We have another episode in the can here. Our guest, Mr. Sean O'Dowd. Thank you, Sean, for being on today.
Thank you for having me. It's been a lot of fun just chatting about this with you.
The pleasure has been all mine. Ladies and gentlemen, all of my real estate peeps, this is Brian Lucier from the Why Not Real Estate Podcast, signing off, and we'll see you on the next one.